everyone. Super excited to be here. I've been wanting to come up to Montreal for actually years and finally got here. So I'm thrilled. Thank you, Rebecca, for the wonderful invite, and it's been incredible being here the last few days. So how many founders in the audience? Hopefully mostly founders. Put those hands up. Okay, great. How many people are raising capital or have raised capital? All right, a little bit less. Well, I'm going to save a few minutes for Q&A, so please tee up your questions for the end. I hope that this is going to provide kind of a framework of things to think about in terms of fundraising. It would be great to have your questions. So the name of the talk is What's Your True North? It's around early stage fundraising. But I could really call the talk Maybe Venture Capital is Not Right for You. Or supporters in the front row, or different alternatives to venture capital. So we'll talk a little bit about how to figure out what type of funding is actually right for you. So a little bit about myself. So I come from a family of entrepreneurs, but really small business entrepreneurs. So my grandfather owned fruit stores in Brooklyn. My grandparents were all immigrants. My other grandfather, he was an accountant and hung his shingle outside his house and had a practice in the basement. Both my parents worked for themselves. And so the model growing up was really around creating wealth independently, but really like working for yourself and figuring out a model that works for you. So that was kind of my model growing up. And despite that, I ended up at really big companies. So I worked at Nike and JP Morgan and kind of learned how to be in that big corporate beast. And at some point, 2006, so pretty early, I left all that to start a startup. Most people thought I was pretty crazy. Most people in my world were working in corporate or other very traditional places, and there I was starting a tech company, not as a non-technical founder. And so because I'd come from this kind of traditional background of corporate, I was very focused on revenue and profitability. And so our company actually, from pretty much day one, we bootstrapped it, and we were actually doing quite well. We were hitting all the milestones, all of our goals. And we took in a very small amount of not of venture capital. We took in a very small amount of kind of friends and family to help us go, and then ended up not raising any more capital. So we were hitting all our milestones. Things were looking pretty good. I made a lot of mistakes along the way, but that's a different talk. And all of a sudden, the business became a little bit unmanageable, and I had to figure out what to do with it. I got on an airplane one day. I sat next to this guy. After 3 hours, he said, "I'm going to buy your company." And a few months later, I sold my company. So this slide, success and failure, was really a moment for me where I kind of understood investing in a very different way. So for me, I'd sold my company, I'd made a bunch of money, I was able to buy an apartment, do a lot of things that I set out to do. But it was a pretty small, modest exit. I'd only run the company for 3 years, but it felt like a success to me. The thing was, this company would have been a massive failure to most of the VCs that I know, right? Didn't turn into a billion-dollar company. And I would go out to California and people would be like, "Oh, yeah, you worked really hard on that company, Jenny. Too bad it didn't work out." And I was like, interesting. Everyone in my company had like this great job, and it afforded me kind of all this freedom. I was taking a year off, and yet I was a failure to some people, and to some people I was a success. So I was trying to kind of understand this, and I realized that dichotomy, a lot of that is just not really understanding when to take the right capital at the right time. And so kind of fast forward to today, where I really consider myself, less of an investor and more as a mentor and a coach to startups who all come and pitch me. I've invested in about 130 companies, and these things come up time and time again of, are you pitching the right deal to the right investor? So I kind of came up with this framework of what's your true north? And so the first thing I do is when I meet a founder is I sit down with them and I really try to understand what type of business do you want to build? Do you want to build a massive billion-dollar business? Do you want to build a lifestyle business? And there's lots in between. And the truth is there's really no right answer, but it is a moment of introspection for you to figure out what type of company you actually want to build, because that will help you figure out what type of capital is right for you. So I'm just going to very quickly go through some options, and then again, at the end, love to take some of your questions. So a lifestyle business. That was, the fruit stores in Brooklyn, right? So that was a small business. Potentially you could maybe get a loan for that, but, really focused on something that was modest. And I think, today there's, if you say that you're building a lifestyle business, maybe more of a services type business, in the tech world, people kind of look down on you. But that's actually, if you look at the US, like the US was built on small businesses, right? And so it is something to celebrate, but I feel like in the tech world, we've kind of decided small businesses are not great businesses, and they actually are not great businesses for venture capital. So the slow and steady, so what's that? Many businesses don't have, the timelines aren't really aligned for the objectives of, say, venture capital. They want to really focus on profitability. They want to get to cash flow positive, and they're not really thinking about a timeline. These are great businesses to run. You can slowly hire people, and you can really build a nice business. Again, probably not great for venture capital, but kind of awesome businesses. I'd say my company, Switch Mobile, was maybe the mix between a slow and steady and a double and a triple, right? And so doubles and triples are kind of interesting, right? So think of it as, your investor would get 2 to 3 times back their money, probably in a shorter time horizon. And these businesses can be really great for early investors. You're an angel investor, you run a micro fund. Doubles and triples, can really be helpful. $100 million business seems like we all would like to sell our companies for that. Again, certain type of investor is looking for, an exit that is, more than 100, less than 100, and so you really have to understand the objectives there. And then, of course, we have our friendly unicorns. Everyone loves that, but not everyone wants to build a business that, is that high-growth business that's going to take in that much capital. So who really cares about this? So funding options depend on getting this right. And it really is, coming back to my first point, looking introspectively and really deciding what type of company you want to build, what's right for you. So that first money, the friends and family money, those are the people that know you. Those are the people that will invest in you no matter what you're doing. They don't care about valuation. They just think that you're awesome. You execute really well. And those people can actually be good investors across the spectrum of businesses that I described, right? And so when you need a little bit of extra cash, probably the people that you've been working with, the people that people in your community are great supporters. Angels and accelerators. So at Techstars, we feel very aligned with our founders because we actually take common stock. So we are early stage founders and investors, and we are aligned with your objectives. And so if you want to build a smaller, a double or a triple, actually that can really work for many accelerators. If you have a corporate accelerator, oftentimes their objectives are to help you get pilots and commercial partnerships, and they're also very much aligned. So really kind of understanding the objectives of your early investors. And angels are pretty much the best because angels, they don't have limited partners. They have no one to answer to, and they're very patient capital, right? You want to build a business over 15 years. Angels are, for the most part, pretty great. Again, it's really about having the communication with those angels to make sure that that is, in fact, in line with what they're thinking. So angels, accelerators can be good for kind of most of the stages that we spoke about earlier. Microfunds, scout funds, and alternative funds are really kind of another category that has come into play more recently. So microfunds usually, say 50 million or less. Sometimes a microfund can be 5 million. And for a microfund, think about a double or a triple, right? So they put in a few $100K, 2 or 3 years later, they triple their money. Well, that's actually not bad for them, or that's not going to move the needle if you're a $200 billion fund. Scout funds are kind of interesting because many times a scout fund the money is actually coming from larger funds. And so with scout funds, they often can put money in at the earliest stage, and they're also pretty happy with modest returns. So you can do pretty well as an early stage founder who maybe doesn't want to build, the unicorn business with a scout fund. So I'd look at those. Alternative funds. So There's one called Indie VC, and they're really popping up, all over right now. And these funds are focused more on profitability and aligning with the founders at an early stage in terms of what their objectives are. And so potentially what they'll do is they will invest in the company and then do some type of revenue share with them, or it'll be some type of loan and payback model. And those are really interesting to look at. There's more and more kind of popping up, I think, to fill this gap. Seed funds. So that's, I think, what most people go out and pitch. And seed funds come in all, shapes and sizes. And so you really have to understand the math, right? You have to understand what is it that drives these funds in terms of their portfolio construction. Do they need to have a certain amount of, large exits to return capital to their investors? So if you're a really early stage company, I would look at seed funds that are smaller, because the smaller they are, the more likely they are to have more options in terms of how they can return capital. So seed funds, you have to really look and see what their economics are. And then you have, of course, like Series A and B funds. And with them, you really have to understand venture math. And so if you're not building a unicorn-type, high-growth business, it's going to be very hard to get Series A from one of these investors. Again, think of the math. You're a $1 billion fund. That means that if you're able to somehow maintain 20 or 30% in all these companies that you're investing in through to the exit, so over at least a 10-year period, how are you going to return that capital to your investors, $1 billion worth of capital, before you, as Mr. or Mrs. General Partner, start to get any fruits from that, right? So you have to return your capital before you can actually make any money as the general partner. So really understanding that and being kind of honest with yourself of what type of company that you're going to build versus what type of company and expectations the fund has. So that sometimes can change for later stage for growth and kind of private equity, where they're looking for something a little bit different, but most of you guys will be kind of pitching the seed and Series A funds. So super important to pitch the right investor, the right deal. And founders, I think, oftentimes get what we call founder happy ears, where they look at Crunchbase, or they look at whatever articles, and they say, Sandhill Road, Series A based fund, who put, a small check into an early stage company, and they're like, oh, well, look, Jenny, they did an early stage deal. Well, why don't you look at all the deals they did that year? They're mostly putting $5 to $10 million at Series A, and so you really have to focus on funds that meet your objectives, and that is, kind of the key to fundraising. And really the way to do this, build out a spreadsheet, very simple, do your research. You have to kind of look at multiple sources, and don't find the outlier, right? Because chances are you're not the outlier. Find the patterns, right? Do these companies, do these funds invest in founders who really want to build smaller businesses, or are building in niche businesses, or in more kind of industries that potentially, right now we can't see billion-dollar exits. So really finding those investors, super important. Be intellectually honest about your goals and objectives. So sometimes founders say, well, I don't really know. I don't know how big this could get, and I don't really know how big I want it to get. And so really spending time, doing your market research, understanding, how big you think the market can be, is going to help you find the right investors. Do your research, and what's good is that right now there's a lot more options. So, unlike a few years ago where it seemed like everything was a Series A fund or an angel, right now you have all these alternative funds that are popping up that are really looking to support founders with different agendas. So with that, I would love to open up to some specific questions that you guys have around early stage fundraising. So I think there's some mics going around. Don't be shy. I know you're all going to rush me after the stage, so. Not one question. Wow. Come on, Montreal. This is a little disappointing. All right, over there. Good.
Thank you so much. What are some best practices for managing the investor relationship after you get the investment?
Really great communication. So I have a situation right now where I invested in a founder pretty early. The founder now has a term sheet for a Series A, and all of a sudden the founder goes silent because the founder's trying to figure out pro rata, right? And this is the worst thing that you can do. You have to keep on communicating with your investors. So communication is key, and what I recommend are you do monthly updates. So monthly updates are really critical. And most founders, they're like, I don't want to do the monthly update. I have nothing, I have nothing monumental to say, I have no milestones, or there's bad news. That's when you have to over communicate with your investors. You want these people supporting you through the long haul, and it's super important to, keep them engaged and really on your team. So open communication. My founders, they can text me at any time, they can call me at any time. I want to be incommunicado with them. And also just the monthly updates are great because that's very quickly, I can kind of scan it, see how things are going, and make sure you add asks. Super, super important is that you have an ask. All right, now people are getting excited to.
What's your take on debt financing as opposed to equity financing?
So like a convertible note?
Yeah, I think it went, oh no, it's good. Yeah, so instead of, for instance, trading equity to get financing, you just take on debt.
Yeah, so I think, for many years, debt was an easier way. So you do a convertible note, and that was mostly because if you were to do an equity round for a $500K investment, your legal fees would be $75K, and that actually didn't make sense. So now it's actually really changed, at least I can speak for the US, where you can get an equity round done for less than $10K, and you can do it quite easily. And so there's kind of a resurgence, I think, of investors really wanting to do equity. That said, the general rule is, at least in the US, in New York where I live, under $1 million, super easy to do a note or a safe. It's quick, you can get the documents, basically online, and pretty standard. Anything that's like over $1 million, that's priced and is going to have a lead, they're going to want to do an equity round. Great question. Someone over there had a question? No?
Hi, my question is actually around the alternative funds. Where did they come from, and what are you seeing the alternatives they're actually including inside those types of funding?
Sorry, I didn't hear the last part.
Where they're coming from, and what sorts of solutions they're providing inside that alternative as far as the fund themselves.
Yeah, so oftentimes they're looking for post-revenue companies, so companies that have a little bit of revenue. They kind of are looking a little bit like small business and lifestyle businesses, but there's profitability that's coming. And so those, as I mentioned, so sometimes what they'll do is that they will give essentially a loan to the company till they hit a certain milestone, and then there's a potential kind of upside for them where they get paid back and they get, potentially a percentage of sales or however they structure it. So there are many out there, and I'd suggest that you kind of research them closely. This didn't really exist 2 years ago, so I find it, pretty exciting that that many people are, many funds are actually thinking about alternative models, really realizing that one size does not fit all entrepreneurs. So I think that's all the time we have. Thank you guys so much. I'll be around for questions.